Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, we sit down with Adam Butler, CIO of Resolve Asset Management, about risk parity as an investment strategy. From what risk parity is to the types of investors who may benefit from allocating to risk parity, Adam helps break down risk parity and explains why investors may want to be looking at strategies like this now and in the future. They say diversification is one of the only free lunches in investing, and risk parity investment strategies can help many investors diversify beyond traditional stocks and bonds. As always, thank you for listening. Please enjoy this discussion with Resolve's Adam Butler. Adam, second time around on Excess Returns. Thank you for joining us.
I'm always happy to chat with you guys. I'm glad you invited me on again. This is going to be a great topic.
We first had you on, it was episode 51. We're now 150 plus episodes into the podcast. And so like you guys, I think we're committed to sort of educating investors around, topics that we're interested in learning about, and that we can have people like you on to help us understand some of this stuff in more detail. One of the things I wanted to also just mention is, and I appreciate this, you invited Jack and I on Resolve Risks a few months ago. I wasn't able to make it. I kind of hung Jack out to dry, and that's a continuous running joke that we were both like, how are we going to do on this Resolve thing? And then I backed out, and it was Jack only.
Well, I mean, if we're going to pick the most handsome, smartest one of you guys, clearly it's going to be
just to give a little background on this, basically the Resolve Riffs, I can tell you, there's three things about Resolve Riffs. One is that the hosts probably cumulatively are the smartest hosts of any investing podcast. Two is the guests are typically PhDs. And three is it's live. So when Rod asked us to come on, I was like, Justin, I'd love to talk to these guys, but we're probably not qualified to be on this thing. So of course Justin's like, oh yeah, we'll do it together, no problem. And then a week before we're going on, he's like, yeah, I can't make it. You're on your own. So so it was probably the only podcast I've done where I was definitely nervous to do it. So hopefully I was able to at least hold my own with you guys.
Well, you're very gracious to say that, but I thought you were fantastic, and we had a lot of fun with it. So we've gotten a lot of great feedback.
Yeah, so Adam, we wanted to have you on today to talk about this idea, this concept of risk parity, kind of dissecting or understanding what it is, how it's implemented in an actual investment strategy. How the current market has changed a lot over the past 6 to 12 months, and how sort of risk parity strategies may be playing a much more important role for investors in their portfolios going forward. But to start, I thought we could maybe talk about the 60-40 stock bond portfolio, and how the setup for that portfolio, while maybe it's improved a little bit with rates increasing and valuations coming down, how the setup really though isn't that great going forward. So maybe we could start there, and then we can kind of get into all the stuff on risk parity.
Sure, yeah. It requires a little bit of background on the overall framework for risk parity for us to kind of fit 60-40 into it. But if you think about portfolio balance or diversity, you want to have a balanced exposure to all the different type of economic environments that you might encounter. And you can think about economic environments as kind of falling along two different axes. One is, are inflation expectations rising or falling? And the other is, are growth expectations rising or falling? And so 60-40 is typically 60% stocks, 40% bonds. So it's just stocks and bonds. And we know for stocks that they're fundamentally designed to do well during periods of increasing growth expectations, relatively benign inflation, and abundant liquidity conditions. Obviously, we've had those three legs in place over the last 10 years. Bonds, on the other side, do well during benign inflation conditions, and typically when growth is not dramatically exceeding to the upside, because typically that's accompanied with inflation, and bonds don't like inflation, right? So both stocks and bonds benefited from this kind of relatively slow growth environment, but where growth kind of fairly persistently just slightly exceeded expectations. We had benign inflation, which was good for both stocks and bonds. And we all know we've had abundant liquidity in spades with the Fed and global central banks buying well over $100 billion worth of assets a month for years and years on end. At the moment, we're coming into kind of the reverse environment. We've got first of all, world central banks removing liquidity. So one leg of the stool is sort of being kicked out from under us. Inflation is no longer benign. We've had inflation CPI prints in the US above 8% year over year. And in other parts of the world, Europe, for example, they're up into the low teens. And depending on how you measure it, sometimes in the mid 20s. And there's some ambiguity about growth, right? Obviously, we had a substantial growth shock sort of starting around March, April 2020, when the governments around the world injected large amounts of money directly into people's savings accounts, gave them a dramatic amount of spending power, and then they turned around and spent it, first of all, on goods that they ordered from Amazon, and are now sort of shifting, or over the last 6 or 8 months, had sort of shifted into the service sector. So, it looks like growth is kind of the ambiguity here, whether or not we've got slowing growth or whether growth is going to continue to come in a little stronger than expected. But two of the legs of the stool that do well for 60/40, this sort of abundant liquidity, that's reversed, and the benign inflation has also reversed, right? So that explains in large part why we've seen a typical 60/40 portfolio fall on rougher times so far over the last 6 to 12 months.
Yeah, like when you look at like the future return expectations from places like Vanguard and other shops, it's like lower than average historical stock returns given where valuations are, and then bond returns are low too. So the standard 60/40 looks like it's set up to produce a lot lower returns going forward than it has in the past 20 or 30 years, I think.
Yeah, one of the things to look at is real rates, right? I mean, what investors actually should care about, now whether they're emotionally anchored to this in the intermediate term remains to be seen, but what they should care about over the long term is the returns that they get in excess of preserving their purchasing power, so in excess of inflation. So, it's one thing for nominal returns to be reasonable, sort of in the 5 to 6% range, maybe. I just recently chatted with Antti Ilmanen from AQR. I think he made a good case for why we should kind of expect stock returns to be in the kind of 5-6% range nominal, and bond returns, call it 2 to 3%. So, maybe you're in sort of 4 to 5% nominal for your typical 60/40. But if inflation is running at 5 or 6%, then your real return, you're actually losing money, or your wealth is decaying relative to the increases in the cost of living. So, I think investors may be expecting reasonable forward returns for a typical 60/40 portfolio in nominal returns, but they may not be considering how the different inflationary dynamics that we're seeing for this decade may overwhelm whatever sort of moderate growth that they might expect on their 60/40 portfolio. So they need to think differently about that than they have.
So that's sort of a nice, I guess, backdrop for sort of getting into risk parity. So where we want to start with you is just at a high, broad level. And remember, a lot of our listeners are retail investors, so it's not like we have an institutional, mostly viewers. So if you were to describe it to your average investor, a risk parity strategy, like how would you articulate that?
Well, it actually starts with something really basic that I think everybody's familiar with, this idea of not holding all your eggs in one basket, or, all the ancient texts give a nod to this idea of, you should own some of your wealth in land, some of it in currency, some of it in loans, or that sort of thing. And, in the mid 80s, Harry Brown published a book on what he called the permanent portfolio, which is kind of hold a quarter of your wealth in stocks, quarter in bonds, a quarter in gold, and a quarter in cash. The idea that these different investments are fundamentally designed to do well in very different economic environments. And then Ray Dalio in the early 90s sort of expanded on this concept, and he called it an all-weather portfolio, which later became kind of this risk parity portfolio. And it combined these concepts of diversity which is what sort of Harry Browne was trying to get at, right? You want to hold assets that are fundamentally designed to do well in different economic environments with the concept of balance. And so let's get into what that means. So diversity, just thinking along the two major drivers of asset returns, right? Changes in inflation expectations and changes in growth expectations. So diversity means holding in your portfolio a basket of instruments that are fundamentally designed to do well in all of those different economic regimes. We've already talked about how stocks do well during periods of stronger than expected growth, benign inflation, and abundant liquidity conditions. Bonds do well in benign growth or even maybe lower than expected growth, benign or slowing inflation conditions, and abundant liquidity conditions. But what we haven't talked about are assets that are fundamentally designed to do well during periods of much larger than expected inflation dynamics, right? So neither stocks nor bonds are really designed to do well in an inflationary environment. And there are a couple of different types of inflationary environments that we should probably talk about. The first type of environment is the one that everybody kind of refers to in the 1970s, where you have these major supply shocks. In the 1970s, they derived from oil shocks, the oil embargo and the deposement of the Shah of Iran, the Iranian War. And so that sort of propagated into prices everywhere and lineups at the gas pump, et cetera. And there are a variety of other dynamics that drove inflation rates much higher than expected in the 1970s. And in the 1970s, central banks around the world took steps to battle inflation. So they wanted to keep real rates positive. So they tried to keep the Fed funds rate and interest rates above the rate of inflation. And what that meant is that they had to keep raising interest rates, which punished bonds. And it also, because it raised the discount rate on stocks, it punished stocks. So stocks and bonds both went down together or did poorly together in real terms in the 1970s. But in the 1940s, late 1940s, early 1950s, as we were coming out of the war, the governments of the world took a very different tact. They said, well, we're going to allow the debts from the war to inflate away. And the way they did that was they held interest rates below the rate of inflation. They engaged in what's called financial repression. And that ended up allowing stocks to do relatively well because you had low real interest rates. So they never really encountered this high discount rate, which punished equity valuations, right? So there are inflationary environments where equities can do well, and then there are other inflationary environments where equities do poorly. Bonds don't do well typically in any kind of inflationary environment. But what does do well in an inflationary environment is typically commodities. And commodities are vastly underrepresented in most people's portfolios. If you go to the 1970s, for example, a broad basket of commodities grew at low teens % annualized in real terms, and gold grew at high teens per year in real terms in the 1970s. So even a modest holding in commodities and gold type assets would have allowed a truly diversified portfolio to do well in that inflationary setting. And we had a similar dynamic play out in the 1940s and 50s. So the other thing that governments of the world sort of introduced in the 90s, the late 90s, were these inflation-protected securities. So institutions often protect against inflation by investing in securities where the rate of payment on the coupon of the government bonds increase or adjusted higher if inflation increases. So they preserve their coupon values in real terms, and that's another way that investors can hedge against inflation. But so just again, to sort of close a loop on this, diversity is the idea of holding all of these different types of markets in the portfolio that are fundamentally designed to do well in very different economic environments. That means owning bonds for the type of economic environments that bonds are designed to do well in, stocks for the same reason, but also owning commodities and treasury inflation securities or break-evens, or there's other more exotic instruments that you can use as well. So that's that's diversity. And then the other side of the coin, which Harry Brown didn't really touch on very much, is this idea of balance. And that's where I think Ray Dalio and the forebearers of this risk parity concept really began to differentiate.
You did a really good job explaining what risk parity is, but I want to also ask you about what it's not, because you'll still see these days on Twitter, in the media, you'll still see people talking all the time about, well, what risk parity really is just stocks, and then we lever up some bonds, we combine them together, and they'll talk about, oh, that must be doing horribly this year because stocks and bonds are down together. Like, where does that come from? Like, how did people get to the point where they believe that that is risk parity?
Yeah, Jack, it's clearly you're an experienced interviewer because it's actually a perfect segue. So the way that risk parity, so we talked about diversity, right? The other side of the risk parity equation is this idea of balance. And the way that most people explain this concept of balance is they use what people are used to, which is a stock bond portfolio, right? So let's just use a portfolio that's 50%, say, S&P 500 and 40% in the Barclays Aggregate Index, right? So typical diversified U.S. bond index. Well, you'd think you got 50% of your capital in stocks, 50% in bonds, you must be perfectly balanced. In reality, because stocks are so much more volatile than bonds, so stocks, for example, typically on average go up on about 1 to 1.5% per day. Bonds on average kind of go up between 0.3 and 0.5% a day. So on any given day, the movement in the portfolio that's 50% stocks and 50% bonds is mostly going to come from the movement in stocks. And in fact, if you examine the proportion of the movements of the portfolio of that's 50-50 in stocks and bonds over time, what you see is that about 90 to 95% of the day-to-day or week-to-week or month-to-month volatility in that portfolio comes from the stock side. And only about 5% comes from the bond side because there's such an imbalance in the amount of volatility that each of those markets are contributing to the portfolio. So you see what I did there, right? I used a stock bond portfolio to describe this idea of imbalance. And then the next step is to say, well, how do you create balance in a stock bond portfolio? Well, if you want stocks and bonds to have to express about the same amount of risk in the portfolio, then you need to hold about 80% in bonds and 20% in stocks. So that's great, but what's the problem with that? Typically that portfolio, because it has such a high bond concentration, or in capital at least, has a low expected return, right? We're holding mostly bonds. Bonds have low returns, so that portfolio has low return. So for a risk parity investor, the way you overcome the fact that typically a well-diversified portfolio, if you don't lever it, has a low expected return, is you lever the entire portfolio up, right? So you say, let's say that portfolio that's 80% bonds and 20% stocks has an expected return of 2.5%. And you want a portfolio that delivers 5%. Well, then you would just take the 80% bonds, 20% stocks, levered up. So now you've got 160% in bonds and 40% in stocks. You're still preserving that 80-20 ratio. You've still got an equal amount of risk in stocks and bonds, but it looks like all you've done is kind of levered the bond component, right? So that's where people think, oh, a risk parity portfolio is just a levered bond portfolio. It's not. It's a balanced portfolio where you've levered all of the assets in the portfolio to hit a target return. And in order to do that, typically the bond exposure goes above 100% because you need more bonds in the portfolio than stocks. Now, this is where, if I were to stop here, people will be like, oh, so a risk parity portfolio is a stock bond portfolio that holds a lot of bonds that's kind of levered. So you hold more than 100% in bonds, like 160% in bonds. And that's why it's so important to close a loop here, because risk parity or all-weather investing is about both diversity, holding all of these markets, all the global stock markets, all the global bond markets, all the global commodity markets, and other inflation protection instruments, all of those in the portfolio, and making sure that the markets in that portfolio that have lower risk have more capital in that portfolio, and the markets that have higher risk have less capital in the portfolio, so that all of those different diverse asset classes are held in perfect balance. And that way all of them are able to express their unique personality, and they all have an opportunity to deliver their maximum benefit in whatever economic environment we might see in the future.
Is some of that misconception based in reality? So are there, and I should probably know this, but are there funds out there that call themselves risk parity that just have stocks and bonds?
No, not to my knowledge. I actually did a little bit of a quick audit a couple of months ago because there was a lot of misapprehension about this on Twitter and on other social media channels. And, Corey Hofstein and I decided we would look into whether or not we could find any, and we couldn't find any actual products out there that deliver risk parity with just stocks and bonds, because it's just so antithetical to the broader concept, which must include both diversity across asset classes and balance, not just balance in whatever capacity or whatever markets you want to choose.
Yeah, it's weird that the misconception, it's weird that it continues despite the fact that there really is no evidence to suggest whatsoever that anybody's building risk parity that way. I want to ask you about, we've talked about the major asset classes that are in a risk parity portfolio. I want to ask you about how we think about the assets underneath there. So you've sort of talked about, you want to hold all the commodities, but I think in practice, it's probably hard to hold. There's a lot of commodities, so it might be in practice hard to hold all of them. Or, on the bond side, you have a decision between, obviously government bonds might be good for the type of environment you have bonds in there for, but also there's corporate bonds and a lot of other stuff out there. So how do you think about, within the asset classes, what you want to hold?
That's a good question. I don't think there's any sort of perfect answer, but it's helpful maybe to frame the objective of the portfolio using language that I hope many listeners will connect to, right? So the purpose of constructing a portfolio is typically to generate the maximum amount of return per unit of risk. Or, stated another way, if an investor has a certain minimum required return that they want to hit, well, they want to hit that required return with the minimum amount of risk that they need in order to hit it, right? And typically, an asset's expected return is proportional to its risk, right? Now, risk can kind of be measured in a bunch of different ways. Oftentimes, the literature for all-weather or risk parity defines risk in terms of an asset class's volatility, right? So the idea behind risk parity is that if you hold all of these diverse asset classes in perfect balance, you're taking the view that each of these diverse asset classes, because they've diversified away all of the diversifiable risk, and all we're left with is the non-diversifiable risk, that you're going to get about the same expected return on the diversifiable risk for each of those markets. So, all of those markets have similar sort of risk-adjusted returns, where risk is defined by non-diversifiable risk, because risk parity is all about diversifying away all of the risk that you can diversify away, right? So you're only going to get rewarded for non-diversifiable risks, right? So then the question is, at what level of aggregation under the hood are you getting rid of all of the non-diversifiable risks? Now, or all of the diversifiable risks rather. Now, if you could, optimally, you would take all of the world's listed securities, all of the individual securities, so all the individual stocks, all of the individual bonds, and you would perform one big global optimization, and you would then hold all of them so that they're all creating a portfolio that has diversified away all the diversifiable risk, and all you're left with is the non-diversifiable risk. In practice, you typically take some level of aggregation. So for example, a lot of risk parity programs are run using futures markets. And futures typically track global equity indices, right? So there's a future that tracks the S&P 500, one that tracks the Dow, one that tracks the NASDAQ, one that tracks the FTSE in the UK, or the MIB in Italy, the Nikkei in Japan, et cetera, right? So you take all these different global stock market indices. Then there's futures that track all the major global bond indices and even short-term bonds and rates like Eurodollars, SOFR, and all that kind of stuff. And then you've got, depending on how far down the liquidity ladder you want to go, you've got a couple dozen, maybe 3 dozen different commodity markets that you can allocate to in the futures markets. So, we sort of think about, or it's common for a global risk parity mandate, many of the global futures funds will do this, they'll either bucket all of the equity index futures into the equity bucket, bucket all the bonds into a bond bucket, bucket all the commodities into a commodity bucket, maybe weight the commodities on risk or maybe equal weight them, and then hold an equal amount of risk in the equity bucket, the bond bucket, and the commodity bucket. We don't quite do it like that. We try to actually create maximum diversification across all the different equity indices, all the different bond indices, and all the different commodities as part of one optimization, because there is diversifiable risk that you can eke out of the portfolio by doing it at that level. But, by doing it that way, you are kind of squeezing 90 to 95%, I think, of the total diversifiable risk available out. And so you really are just left with this kind of non-diversifiable risk. And you've got a portfolio that is fundamentally designed to generate the highest return per unit of risk, assuming that markets are in fact relatively efficient. In other words, that investors do try to maximally diversify, and that investors are only really rewarded in markets for the non-diversifiable risk, or the risk that they cannot possibly diversify away.
Yeah, it seems like sort of a balance between diversifying and complexity. You want to achieve as much diversity as you can without bringing too much complexity into the process. Does that make sense?
Yeah, absolutely. There's complexity, there's transaction costs, there's liquidity challenges, there's a number of different operational complications that you need to deal with. But yeah, I think that's a great way to state it. You want to maximize diversification to the point where operationally, at the margin, it's no longer useful.
You alluded to this idea before about volatility targeting. And this is something probably a lot of investors who listen to the podcast may not be familiar with. And, when you see these risk parity strategies presented, you'll see them at, a level of 12% volatility or 8% volatility or something like that. And I'm wondering if you could just talk a little bit about, how those volatility levels are sort of determined and how that process goes of targeting a specific level of volatility.
Sure. So let's take a simple risk parity portfolio that might hold the MSCI All Cap World Index. So now you've got a cap-weighted equity portfolio. The Barclays Global Aggregate, so a global portfolio of bonds in proportion to the size of issuance, and a common commodity index, call it the Goldman Sachs index or the Bloomberg index. And you can effectively do this with ETFs. So that portfolio, if you were to hold them in risk parity, let's say it might hold, let's say 20% in the equity index and 20% in the commodity index and 60% in the global bond index, right? And that portfolio might have an expected return of, let's say, 3%, right? Well, most investors don't want to own a portfolio that only generates 3% nominal, right? They have higher required return objectives than that. So what will typically happen is you'll take that portfolio and, let's say the portfolio also has, just for the sake of easy math, an expected volatility of 3%, right? So you're gonna lever that portfolio, say 2 to 1. So you're gonna borrow at the risk-free rate, and you're gonna lever that portfolio up 2 to 1. So now the portfolio has an expected volatility of 6% and an expected return of 6%. I'm using return here loosely because we're actually talking about excess return, right? Because when you borrow, there's a cost for that. But so now you've got a 6% expected return, you've got a 6% volatility, and you've levered the portfolio by 2 times, right? So by targeting volatility in a risk parity framework, you're just targeting a higher expected rate of return, right? In order to hit the required return that is close to most investors' preferences, right? But typically, companies that run risk parity mandates, they'll offer a risk parity at a 6% volatility, and an 8% volatility, at a 10% vol, at a 12%, at a 15%, right? And it'll just depend on the required return of the underlying investor. It may depend on other factors like leverage constraints or other sort of qualitative constraints that the investor might have placed on the portfolio mandate. But there's also a question of how you target volatility. So are you going to measure the current volatility of those markets and then expand and contract your total leverage in the portfolio over time in response to changes in the volatility and correlation conditions of the underlying markets that you're investing in. That's more of a sort of dynamic risk parity approach, and a lot of the popular products do that, but they don't do it, let's call it hyper dynamically. They might use a sort of 2 or 3 year historical volatility and correlation estimate. So it does expand and contract through time, but it expands and contracts relatively slowly. Some of them respond much more quickly. They're using a more near-term estimate of volatility and correlations, and you actually could see both the weights in the portfolio and the total portfolio leverage expanding and contracting quite rapidly. Typically, only smaller funds would run it that way because you just don't have the liquidity absorption for much larger funds to run at that level of vol management. And then you've got sort of Bridgewater's all-weather that doesn't even use historical volatility and historical correlations explicitly, but rather they have a fundamental econometric model that they use to have a strategic long-term weighting to all of these different underlying markets. And when volatility expands and the value of some of these markets contracts, they'll actually be buying more. So for example, typically when stock markets decline, volatility increases. So a more dynamic risk parity strategy, they're observing the volatility of equities increasing. They're selling equities as equities go down. Whereas Bridgewater is saying, we want to hold a static weight in equities. I don't know, call it 20, 25% in equities. If equities drop, all of a sudden their weight in the portfolio may be 20%. So they need to buy more equities as equities are dropping in order to get back to their strategic weighting. So there's different ways that different all-weather or risk parity investors approach this volatility or risk targeting mandate.
I assume nobody, takes it to this level in the real world, but just for me, as an investor who is not that risk averse, I was just wondering, given that we have a lot of different assets that do well in different environments, it seems like you could take this to a pretty high level of volatility and it would work over the long term. But it also seems like there might be a certain level where, you might break it, but it would probably be pretty high. And I'm just wondering, has there been research done around that? How high you can take the vol on something like this?
Well, I mean, if you can use the sort of historical empirical data, and you might say, okay, the very long-term Sharpe ratio on a globally diversified risk parity portfolio might be in the neighborhood of 0.5 or 0.6, right? And then you can take the ambient volatility of that portfolio if you don't lever it, and then you can just Kelly size it. And I haven't done it, but I'm going to guess that maybe the optimal leverage would be in the neighborhood of 3.5, 4 times, depending on if you're including rates in the portfolio. And but the other side of this is that it's not like you're diversifying away all risk. You're only diversifying away diversifiable risk, right? There's still 2 important sources of risk that you can't effectively diversify away in a costless way. So, for example, one of those is an unexpected shock to expected future cash rates. So when the Fed makes statements about where it wants the Fed funds rate or about yield curve control or inflation expectations begin to move in such a way that investors anticipate that the Fed is going to take action to increase expected future cash rates, then that affects the discount rate for all markets everywhere in the same direction at the same time. And because what's happening, right? Why do investors take risk in markets? It's because they're hoping to be able to generate a return in excess of what they can get by placing their money in risk-free T-bills, right? They take duration risk in bonds because they're hoping that they're going to generate a higher return on a 10-year bond than they would get by holding their money in T-bills. They're investing in equities because they're hoping that the equities are going to generate a higher long-term return than they would expect to get in T-bills. All things equal, if equities and longer-term bonds were not going to provide a higher return than they would get on holding their money in cash, every investor would hold it in cash because it's immediately available for consumption. And there's no risk on its future value, right? So, they're only enticed to move money out of cash and into risky assets if they believe they're going to earn more on those risky assets than they're going to earn in cash. Well, if the Fed comes out or central banks come out and say, we're going to increase the rate that investors are going to earn on cash, well, it means that all risky assets are going to need to reprice lower so that they are then expected to generate a high enough required return that investors will be enticed out of cash and into those risky assets, right? So that's a risk that you cannot diversify away with a costless hedge, right? You can buy Eurodollar puts, you can buy, there's a variety of ways you can do it, but they're not costless. The other type of risk that you can't diversify away is risk premium risk or sentiment risk, right? It could be that investors one day require a 3% excess return on stocks in excess of cash, but because of a heightened sense of uncertainty, the next day they might require a 4% required return above cash to be enticed into equities, right? That can happen due to geopolitical risk or economic uncertainty or inflation uncertainty. Whatever it is, investors now require a higher excess return above cash. So even if the Fed is not changing expectations of future cash rates, if investors are now requiring a higher premium, then that is going to cause all security values to fall in tandem, right? And so there's no way to diversify those away. In the end, over the long term, those are actually the risks that investors are paid to take, and those are the risks that are rewarded with a global diversified risk parity portfolio.
We've been doing some more work with people who are just starting in retirement. And, as part of that, we've been running more like Monte Carlo type simulations. And, one of the things intuitively going into that, but you sort of learn more as you do it, is how important, limiting drawdowns and managing sequence risk is for people when they're just starting out in retirement. And it would seem to me like looking at this type of portfolio and its ability to do that, it would seem like this type of portfolio might support a much better withdrawal rate than something like a 60-40 portfolio. And I'm just wondering if you've seen any research done around that in terms of like the types of withdrawal rates this will support relative to something like a more standard 60-40 portfolio.
Yeah, so a lot of this comes down to your assumptions, right? If you're going to go back and look at the empirical data, and many people use the long-term historical returns on U.S. stocks and bonds because it's kind of like the lamppost problem. You're familiar with that one where, you got the drunk who's looking for his keys and and he's standing by the lamppost and he's looking around in the light looking for his keys, and a guy comes along and says, "What are you looking for?" "Well, I lost my keys." And the guy says, "Well, did you lose it by the lamppost?" "No, but that's where the light is," right? So it's the same kind of thing with U.S. equities, right? Like U.S. equities have by far the longest historical return data that's readily available to investors. And so investors who like to use long-term returns, and that's prudent because we go through a wide variety of different economic regimes, as we talked about, well, it's good to have access to a data set that goes back as far as possible. The problem with that, of course, is that you're only looking at the history of one market or one economy, right? And in many ways, the U.S. is an outlier. The U.S. equity risk premium is about a little over 2% per year higher than the global equity risk premium. So it's closer to 6%. The global is closer to 4%, right? And the bond risk premium is higher as well by about 0.4%. So you're sort of getting a overly optimistic long-term sense of what to expect from markets. I mean, some very large markets through history, equity markets and bond markets have actually gone to zero, right? The Chinese market went to zero. The Russian market went to zero. The Austrian market went to zero. The Argentinian market went to zero. Chinese market went to zero under Mao. And so, you're not, obviously the U.S. economy is at a stable political environment. They were insulated largely from both world wars, at least the destruction on our continent, right? So there's a lot of things that went really, really well for the United States that maybe we shouldn't count on going forward. So you're better off if you can use a diversified global set of indices, but then you're sort of limited or more limited in how far back you can go, right? So, if you're going to just try and use the historical data to make some of these assumptions, then that gets tricky. Are you also going to use the historical return distribution? We know that returns in many markets have fat tails. We haven't seen a lot of those fat tails in aggregate if you look at sort of globally over the long term. So anyways, I could go on and on about why this is tricky, but really in the end, it kind of what you take out of an analysis like that is going to be a function of the assumptions that you make, right? And in general, our assumption is that the global risk parity portfolio is what you would invest in if you had no idea what the future would hold, right? It's sort of maximally resilient to whatever type of sustained economic environment that we might face in the future, right? So, historically, about 80% of the time, we've had benign inflation and relatively robust economic growth and global central banks that were ready to step in and provide ample liquidity. That has been very favorable to a 60-40 portfolio. There's no guarantee we're going to have that kind of ratio of 80 to 80% benign environment that's positive for 60-40 and 20% of the time that it's not. We may not have that mix going forward. If going forward you still think we're going to have 80% of the time it's going to be fairly rosy for 60-40 and we're only going to have problems about 20% of the time, maybe skewing more to 60-40 in your retirement portfolio or in a long-term wealth preservation portfolio makes a bit more sense. If, on the other hand, you are more agnostic about what the future might hold and think that the 20th century was actually an outlier relative to what we might see in the future, and certainly the 20th century had the largest amount of peacetime and the least amount of inflation that of any history or any century prior. So it's a very optimistic assumption. So if you think that the next century might be more tumultuous, we might have more frequent or longer or more violent inflationary episodes, that the U.S. may lag other parts of the world, then taking a more resilient, humble approach on your assumptions by investing more in a global risk parity portfolio probably will provide for a higher expected safe withdrawal rate, for example, than a 60-40 portfolio. The problem is, depending on how far back you go and how you construct the 60-40 portfolio versus the global risk parity portfolio, you will draw different conclusions empirically from the historical sample.
And, intuitively, this portfolio seems to make sense from that perspective, though, because what you're trying to do is you're trying to take these, the bad outcome when you're in retirement is you have no money left. So that's a really bad outcome, and you really have to avoid that. So this idea of being robust to all the different four quadrants, to me makes a lot of sense when you're trying to limit that problem. We don't know, like you said, we don't know if the 60-40 is going to work better or if we're in a new regime here, but, you're just taking everything and you're looking at all the possible outcomes, and you have something in there to deal with it. So it does make sense intuitively in retirement, from my perspective at least.
Yeah, I mean, like Brian Portnoy said, right? The problem with diversification is you always have to say you're sorry, right? Because there's always going to be one or sometimes two of the major asset classes in your portfolio, in your diversified global risk parity portfolio, that are really sucking, right? If you look at the last decade, obviously, owning up until the last year or so, owning commodities strategically has been a drag. Owning global equity markets outside the US has been a drag. Owning global bond markets has been a drag, right? So any sort of diversification you've needed to apologize for over the last decade. So, it's hard. And ex post, if somebody if somebody is falls prey to what Andy Duke calls resulting, which is kind of just looking at what actually happened and judging an advisor on how they did relative to what actually happened. That I think it was Josh Brown who said, at Hindsight Capital, it's always a good year, right? So if you're always looking back and judging an advisor or a fund manager, et cetera, on what actually happened, then risk parity is always going to look kind of goofy, because you're always going to hold asset classes that really didn't do well, because the historical, last 3 to 5 years, they favored in particular a certain group of asset classes. In the last 10 years, it really favored U.S. stocks and bonds, right? So risk parity, if you're looking backwards, looks kind of foolish, right? Boy, the point is, though, you need to not make judgments about what is in the rearview mirror. You may need to be able to do what Gretzky did and skate to where the puck is going, but that's really hard to know in advance, right? So the global risk parity portfolio says, I don't know what the future holds. I don't know what ratio we're going to get, inflation or growth. I don't know what the magnitude of those shocks are going to be. And I just want to be prepared for whatever comes.
As a factor guy, my tendency with everything is to say, oh, I can enhance this with factors. I can make it better. And, thinking about risk parity, I was interested to talk about like the idea of using factors here. So for instance, if I, overweight the asset classes with the most momentum or try to exclude things with negative momentum, on one hand, you could say, all right, this makes it better. But on the other hand, you could say, well, it defeats the purpose because the purpose is I want assets that do well in all four of these quadrants. And if I'm starting to take assets out in one of the quadrants, I've left myself exposed. So I'm wondering, how do you think about like the idea of maybe using factors or something like this?
From more of a theoretical perspective, the idea for any portfolio is to continue to add as many uncorrelated sources of risk and return as possible, right? So when you think about actual factors, right, as we all know, well, the value factor is effectively a market neutral portfolio that owns on the long side stocks with positive value characteristics and goes short a portfolio of stocks that have negative value characteristics. And the same for quality or low volatility or however momentum, however you want to define that, right? So in theory, you could add the value factor is just another uncorrelated source of returns, just like the equity risk premium or the duration premium or the commodity rebalancing premium, right? For a global risk parity portfolio, you've got all these different risk premia that you're holding in the portfolio. You're balancing across them. So ideally what you're able to do is add in the value factor premium, the momentum factor premium, the trend factor premium, etc. And you want to give an equal amount of risk to the trend factor, to the momentum factor, to the value factor, etc. Right? So in a theoretical framework, that's kind of what you'd want to achieve. That's what we do in our mutual fund product, right? We stack on all these different sources of return. We've got sort of the global risk parity portfolio, and then we add a bunch of stuff: global carry, global trend, seasonality, value, all these other different sleeves, right? In relative risk proportion. Now, if you're kind of a retail investor who kind of wants to do this themselves, then I think in theory, you should get an improvement by, for example, instead of holding a global cap weighted index in your portfolio, maybe hold a global multi-factor index in your portfolio. Instead of owning the Barclays Ag, maybe own an active bond fund, right? There's actually decent evidence that active management is relatively effective in bond funds. And if you didn't want to do that, then maybe you would, a great factor that is underappreciated and underutilized in bonds is the fallen angels factor, right? This idea that many insurance companies and pensions are not able to hold a bond that falls below a BB rating. And so when a bond is re-rated below BB, institutions instantly are required to sell that bond, and they sell it often at a lower price than it should be worth. And so investors that are able to buy those types of bonds earn a premium on that structural factor. In commodities, there's a variety of other premiums in commodities, like the carry factor or the trend factor or seasonality, that sort of thing, right? So those are a little bit harder for individual investors to do on themselves, though obviously, our funds take advantage of those types of premia. So the answer is absolutely yes. The more sophisticated an institution or an individual mutual fund that's able to actually put all these pieces together for you gets, the higher expected efficiency of that portfolio in theory. But investors who sort of insist on wanting to do it themselves can either hold a basket of multiple factor ETFs or a multi-factor ETF for each of the different constituencies, and in theory, expect to get a slightly higher return per unit of risk.
I wanted to ask you about how this relates to behavior, because we run some multi-asset portfolios that go beyond stocks and bonds, and if you look at the points of failure for investors, there's really two. There's one, when they lose money, they might panic and abandon their strategy, and the other is when they look different than their neighbor, they might panic. And so this one's really good, risk parity on number one, and struggles a little bit on number two, because as you alluded to with the Brian Portnoy quote, we've been apologizing for the diversification for a long time up until this recent period where it's worked really well. And so I'm wondering, do you find that maybe that's a big challenge, that maybe that second point of failure can sometimes be harder than the first point of failure? Like investors have a harder time being different than their neighbor than they do losing money?
Absolutely. I think that this is the dominant risk in markets, that 95% of the time, investors are much more afraid of tracking error risk than they are of the loss of real wealth. I think, for example, that's a reason why the low volatility premium exists, is because investors are much more concerned with relative status or relative wealth than they are with absolute wealth, right? It's not nearly so painful for you to lose money if all of your friends and neighbors are losing money at the same time, right? It's extraordinarily painful to lose money if all of your friends and neighbors are making money. And obviously the holy grail is to make money while all your friends and neighbors are losing money, right? But, to do that, you need to risk the opposite, which is to go through periods where you're losing money or not making as much money as your friends and neighbors. I think the entire asset management industry is built around the reality that investors are mostly concerned with relative wealth status and don't really care until sort of extremes, like the extremes of 2008 bear market, the extremes of the 2000 to 2003 bear market. That's when they begin to become concerned about absolute wealth. But the vast majority of the time, they're just concerned about relative wealth.
Do you think, what are the best strategies to mitigate this? So on one side, I think education would probably be helpful. You guys have come up with this interesting concept of return stacking, which makes people's portfolios maybe not look as different as they otherwise would have. What do you think the best ways to deal with this problem are?
Yeah, return stacking is kind of the best way that we've come up with to accommodate this trade-off. And it's funny because, of course, until sort of this year, everyone wanted to own mostly US 60/40 portfolio. But if you go back to 2007, you couldn't pay investors to own a US 60/40 portfolio, right? Everyone wanted to own REITs, emerging markets, commodities. Remember the BRICS, right? No, you couldn't sell US 60/40 in June of 2007, right? And the problem is that the benchmark that investors have tracking error to changes over time, right? So the current return stacking, the original return stacking paper that we released assumed that the core emotional benchmark for most investors is the US 60/40 portfolio. And so we showed how you can have a 100% exposure to US 60/40 and build on these diversifying exposures on top using a relatively novel framework that's only really become practically implementable in the last year or two because certain products were introduced that allowed investors to be able to express this kind of framework. Our fund takes the view that the core portfolio should be kind of this globally diversified risk parity benchmark, but that's rarely people's emotional benchmark. Right? So we're kind of fighting a little bit of an uphill battle in terms of we're going to have large tracking error relative to the US 60/40 from time to time. This year it's great because it's obviously dramatically positive tracking error, but in a few calendar years in the late 2015 to 2019 period, obviously a globally diversified portfolio would have lagged a US 60/40 portfolio by 10 or 12% or more, right? So this is obviously very difficult. You need to understand, investors need to understand what their emotional benchmark is, right? So when they go to dinner parties, what are their friends investing in and what are they going to have envy about if that benchmark is really doing well and their diversified portfolio is doing poorly. Advisors need to be aware of this as well, and make use of the return stacking concept, but with a mix of assets that at least accounts in some way for each individual investor's different tracking error preferences.
For anyone who's interested more in return stacking, we did an interview with Adam's partner, Rodrigo Gordillo, and Corey Hostein on one of our episodes. So if you search return stacking on our YouTube channel, you can get another hour of talking just around that topic. Just one more from me before I hand it back to Justin. You'll see on Twitter all the time this idea that risk parity could contribute to breaking the market. So, the idea is, as you alluded to this before, as volatility rises in equities, risk parity strategies have to sell equities. And there's this idea that this cascading sell loop will develop and, risk parity will lead to like a market meltdown. I mean, do you think there's really any risk to that? Or do you think that really is like a lack of understanding of how risk parity really works?
Yeah, I think the general idea that vol control products may exacerbate market sell-offs has merit. I don't think risk parity or, its kissing cousin kind of CTAs contribute dramatically to that. By far the largest risk budgeted markets or balance sheets in the world are bank balance sheets, and banks need to manage their overnight VAR to liquid markets, and they've got sometimes multi-trillion-dollar global derivative books. So, if the volatility on global rates escalates, then global banks need to rebalance, like de-risk or degross their bank balance sheets in response to changes in VAR estimates. And we're talking orders of magnitude, 2, 3, 4 orders of magnitude larger in terms of the size of those balance sheets and the size of those adjustments that need to take place. So, you've got a variety of different vol management going on in markets. Some of that is mandated by regulation. The bank balance sheet VAR management is mandated by regulation. They need to manage their balance sheets like that. And that will absolutely exacerbate market moves in both directions. In comparison, the couple $100 billion in global risk parity or CTAs, I think has a very small marginal impact.
And also, this smooths itself out over time. Like, no one is running a risk parity strategy with a look back of yesterday or last week or anything, right? It takes time for the volatility to rise before there would be the selling. Is that a good way to look at it?
Yeah, the vast majority of commercial risk parity strategies will not be nearly that responsive, for sure. And thank you for reminding me, because as I mentioned earlier, the Bridgewater all-weather portfolio, which I think is the largest global risk parity strategy, works in the other way, right? When markets are selling off, that portfolio is buying markets as markets get more volatile and sell off, right? So while some number of risk parity mandates might be slightly lowering their exposure to stocks, for example, as stocks become more volatile as they sell off, well, on the other side of that trade, Bridgewater is absorbing those flows because they need to, their strategic stock allocation has declined because the value of the stock side has declined. They need to buy stocks to raise their total exposure back up to their target, right? So you've got this offsetting effect where certain funds are buying what other funds are selling, and all of those funds are swamped by the effects that are going on for rebalancing of global bank balance sheets.
How do you guys think about, like, when a new asset class comes and becomes available? Like, I'm thinking cryptocurrencies or Bitcoin, and how would you think about adding that or incorporating that into a risk parity portfolio? Like, what would it take for you to get exposure to something like that?
Yeah, great question. As we examine the historical performance of, for example, our risk parity strategy, we just at each point in time examine which global futures markets that are launched meet our liquidity standards, right? And so as soon as a new market meets our liquidity thresholds, then we just add it historically over time, because we want to own as many diversified exposures in the portfolio as possible. And so when crypto was launched, we took a very hard look at that. We want to own crypto futures in the portfolio. Unfortunately, regulation has gotten in the way with holding global futures markets. So it's actually extremely difficult, or at least you need to jump through a huge number of regulatory hurdles in order to add crypto to diversified global portfolios, even if you want to just hold CME futures. And so we've opted not to add those, though we very much would love to add those, because one of the major weak spots of these global risk parity portfolios historically has been periods like the last decade where, the vast majority, well over half, and I want to say upwards of 2/3 of all global total returns have accrued to a very narrow segment of the market. In this case, the FANGs, right? Or like the global growth story, right? As we just had an absurd amount of liquidity flow into the system, and investors were rewarded for Ponzi-like dynamics. So, what grew out of that? Well, also crypto, right? So, it would be great to have an asset that is fundamentally driven by Ponzi-like dynamics that we could hold in a diversified risk parity portfolio with appropriate risk weighting. I mean, keep in mind, Bitcoin and Ethereum futures are extremely volatile. So in a risk parity framework, they would hold a very small capital weight, call it probably in aggregate less than 1%. But when you're talking about assets that deliver 4,000% returns in some years, that 1% can be very meaningful in the portfolio, right? So, in general, we want to be agnostic. We want to hold all liquid markets. And crypto especially serves a very unique purpose in that it gives us exposure to the types of market environments which we've experienced mostly recently with these insane central bank liquidity policies that have facilitated Ponzi economics, where typically global risk parity portfolios sometimes lag the most watched indices.
Yeah, to your point, I don't know what the standard deviation is on, Bitcoin, but it's, something crazy. So it'd be, a very, very small percent of the risk parity portfolio. And it probably should be, if people are investing in it, a very, very small percent of people's overall portfolios as well, if they're allocating to crypto. I wanted to just get your thoughts here on some of the things going on in the economy and the market, because I know you have some interesting takes and thoughts on some of this stuff. So the first question is around inflation. And I think there's sort of this question in the market as to whether or not, this inflation is going to subside here, if we're going to work our way through some of these supply chain issues, and if the Fed's increasing of rates is gonna cool things down, or if it's, maybe here to stay for longer than we think, and if maybe the Fed can even, address some of these problems. So just generally, what is your take on the inflationary environment?
I think there's a couple of different things that are happening. One is that, in March of 2020, the global central banks and global governments decided that they were going to pivot their fiscal and monetary policy at exactly the time that the world was entering a completely different supply-demand regime, right? So the governments around the world said, we need to shut down the global economies to moderate the spread of this global pandemic, which means that we need to give households and businesses income in order to be able to live while they're no longer engaged in labor, and when a large segment of them are no longer engaged in production, right? And so the government fire hosed money into people's bank accounts, and so you had an instant demand shock at the same time that there was a reduction in global supply chains, right? We were shutting down shipping lanes. China was shutting down manufacturing. Many of the global manufacturing hubs were almost completely shut down for a time. And so you had a sort of short-term supply-demand imbalance. And it's taken a long time for that to work through the system, right? At the same time, you've had an environment where people are very concerned about climate change. There's been a huge move towards ESG, environmental, social, governance style investing. And it has made the cost of capital for the types of companies that produce the basic materials that we need as a global economy to function, dramatically raised the cost of capital for these companies and made their future cash flows a lot more uncertain. And as a result, these major commodity companies especially just did not invest in the capex required to replenish their dwindling reserves. And so you've had effectively a lost decade in investment in capital intensive businesses. And what that means is, given the life cycle of bringing on new supply, for example, new sources of oil, natural gas, copper, and many of the other potash, fertilizer, that kind of stuff that feed into the raw material supply chain, it's now almost impossible for us to meet global demand for all of our basic materials. And we also, the runway to bring on new demand is measured in several years, not several months, right? So, it's possible, for example, that the Fed right now has up until now at least taken a fairly hard line on whether they're going to tolerate inflation, right? Jerome Powell has invoked Volcker as his model for how to manage inflation, and the market so far has taken him at his word that they will prioritize inflation and they will allow asset prices to fall and growth to slow in order to tame inflation. We're just now starting to see some language come from out of the Fed in their beige book that suggests that maybe several FOMC voting members don't have the same level of conviction as Jerome Powell in their desire to fight inflation expectations at all costs. And so we're seeing now the market begin to price in. So, there's two ways that this inflation shock can play out, right? One is the 1970s inflation shock, where the Fed says, we're going to raise interest rates to fight inflation and we will sacrifice the economy and asset prices to do so, right? The other inflation, type of inflation, is the late 1940s, early 1950s, this financial repression, where the Fed says we're going to keep interest rates low, much lower than the rate of inflation, and allow our debt to inflate away in real terms, okay? So what happens to asset prices over the next couple of years is going to depend on whether the Fed is going to engage in financial repression or whether they're going to raise rates above the level of inflation like they did in the 1970s. If they take the financial repression path, that actually could be reasonably bullish in nominal returns for equity prices and more benign for bond prices, though it's still not a very favorable environment for bonds. In real terms, bonds will deliver very negative returns. Stocks will deliver maybe slightly positive nominal returns, maybe even high nominal returns, but only very slightly positive returns after inflation. And commodities should absolutely tear higher here. If the Fed decides that they're going to try and fight inflation like they did in the 1970s, then we'll have a period of continuing escalation in commodity prices while asset prices get systematically crushed as that, the risk-free rate or the discount rate rises. The other factor that investors are pricing here is this sentiment factor or the risk premium factor. During periods of high inflation, there's typically a lot of inflation volatility and a lot of uncertainty in policy response. That is negative for corporate earnings. And so not only are investors pricing a higher discount rate, in other words, they're pricing the fact that the Fed is going to raise rates into this inflationary shock, but they're also pricing higher earnings volatility, and that requires a higher risk premium, which is also requiring, asset prices to deflate, right? So if they allow inflation to run hot, then you're still going to require a higher risk premium because you're still going to get that more uncertainty in corporate earnings, but you'll get a lower discount rate. So asset prices could, in theory, rise in nominal returns, right? if they're going to fight inflation, eventually we may get a recession. It may be a deep enough recession to overcome the supply bottlenecks in commodities. And so you may actually see a major commodity crash as well. But I would expect that if, in order for the Fed to lower global demand enough to create an equilibrium of supply and demand in commodities, it would have to be a deep recession and probably would engineer a financial crisis. So, you're going to see asset prices really enter sort of a crash type environment in that scenario. In a financial repression scenario, we could chug along with reasonably high nominal equity returns, quite high nominal commodity returns. In fact, commodities might get way out of control, and they may eventually force the Fed's hand, and they may eventually need to engineer a recession. Or we could get oil and other core commodity prices that are so high that they, just consumers needing to take so much from their discretionary budget to pay for raw materials may also lower aggregate demand enough to engineer a recession.
A lot of great deep thoughts in that riff there, taking something from Resolve Riffs. But one of the things too that you kind of opened my eyes to is, and I guess I hadn't really thought about this. I mean, for like the last decade, you've heard about this underinvestment, and it kind of goes back to buybacks. It's like, all these companies were using, all the profits or issuing debt and not reinvesting it necessarily back in the business. They were really buying back stock, and they weren't, and so, but when you think about the result of that for these manufacturing intense businesses that needed the investment, when we had this demand shock due to the shutdown, it kind of resulted in this domino effect. And it almost seems like the Fed won't be able to be as effective with the raising of interest rates if it is in fact, at least in part, driven by this underinvestment in capital.
Yeah, I think so. I mean, the Fed can do an excellent job in reducing aggregate investment, in reducing employment, and eventually engineering a recession, which will hit capital goods and the discretionary sector and eventually the services sector, right? But none of those really solve one of the major underlying fundamental problems, which is just there's not enough supply of fundamental base materials to meet demand. I mean, the other major secular global dynamic that's in play here is that we're having an escalation in geopolitical conflict, right? We're moving from a cooperative world to a competitive world where you've got trade blocs forming now. You've got kind of China and Russia forming. You've just had very strong statements by the Biden administration on how they would take any aggression by China against Taiwan, drawing very clear boundaries. You've got Russia and China talking about coming closer on a variety of different dimensions. And you've got the wake-up call of the global pandemic and this war in Western Europe that are drawing to government's attention the fact that this idea of offshoring our entire manufacturing chain, that's great in an environment when you can rely on the fact that your trade partners are going to deliver on those strategic shipments. But it's not so good when, for example, India is going to decide that they're going to halt all wheat shipments because they need to deal with their own internal problems. Or, China is manufacturing critical components for that go into major military investments in the U.S. Is China going to continue to provide those strategic manufactured components to the U.S. if we get into a hostile geopolitical posture with them? So we've gone from a period where global governments and global companies were trying to maximize the efficiency of the supply chain to a period where we're trying to maximize the resiliency of the supply chain. And those two things are at odds. The efficiency of a supply chain drives down costs, is disinflationary. The resiliency of a supply chain means that you need to reproduce manufacturing capabilities in a variety of different jurisdictions in order to ensure that if one of those jurisdictions goes offline, you've still got that strategic supply in another more friendly jurisdiction. So you need to build new factories. You need to, build new infrastructure, et cetera, in a variety of new jurisdictions. And building factories and infrastructures requires a huge amount of CapEx and a huge amount of raw materials. And so this is the type of cycle that we're moving into that's going to drive demand for these raw materials at exactly the time when supply of these raw materials is constrained by geopolitical problems. Obviously a huge proportion of global energy and global food production is either directly sourced from Ukraine and Russia or has supplies from Ukraine and Russia that feed into them, for example, potash and phosphate markets, right, that are required for food production elsewhere. So demand escalating by onshoring and moving from efficiency to resiliency, supply constraints in terms of raw materials and geopolitical conflict, they're going to conspire to make the inflation genie extremely difficult to put back in the bottle, which is why I say if the Fed wants to truly conquer a commodity market that's spiraling out of control, they will have to engineer a deep recession. And so, they're going to try and walk the tightrope here. It looks like they're going to try and walk back their Volcker-esque real rates, positive real rates, 1970s style inflation fight, and turn it into more of a compromise between financial repression and Volcker-style inflation fighting. I think they're going to find that it's going to be impossible to walk the tightrope. But the market is going to take a long while to navigate this, and policymakers are going to be very data-driven. So I think really what we're going to see over the next 2 or 3 or 5 years even is just a lot of volatility as markets respond and then governments respond to market forces. And there's this, back and forth as we fail to find any sustainable equilibrium.
And by the way, everything that you just outlined in the last 10 minutes is exactly why, for many investors, especially that are in retirement or want a conservative investment strategy, why a risk parity strategy makes a lot of sense. Because everything you just outlined are all uncertainties, risks, potential things that could go right or wrong. But I think that this discussion, the reason we're talking about this is because risk parity is a strategy that can handle all these different types of environments. So this is an important thing to be thinking about for investors that are, in the markets in the long term.
Yeah, I completely agree. And, to Jack's point, and Justin, I know you agree, expanding this concept of risk parity to include other sources of return is going to become more and more important as, if the government is going to continue to raise the expected future cash rate, then at least 2 legs of the 3-legged stool are going to be under pressure. Stocks are going to be in pressure and bonds are going to be in pressure, which means that you're relying exclusively on the commodity sleeve to bail you out, right? Risk parity typically over time has at least two of the major core allocation sleeves working for you, right? In periods of low inflation and abundant growth, you've got stocks doing really well, bonds doing reasonably well, maybe commodities not doing so well. If you sort of look across all these different environments, really only one environment where central banks are actively trying to raise expectations of future cash rates, do you have 2 of these forces kind of working against you and one of them may be working for you, right? So it's more and more important to add stuff like exposure to the value premium, exposure to momentum, exposure to trend, exposure to macro trading and systematic macro trading. These types of sleeves that are agnostic to what the Fed is trying to do or what the global economy is trying to do. They're deriving the returns from completely uncorrelated sources of risk. So this idea of diversification expanding into other types of diversification is more and more important when the traditional sources of diversification can't be relied upon with confidence.
We have a standard closing question. We weren't able to ask you this on the first time you joined us because we didn't have it at the time. But we do have one now. And that is based on your experience in the markets. If you could impart one piece of wisdom or teach one lesson to your average investor, what would that be?
Yeah, I mean, it would be diversify, right? It would be humble about what you know and what you can know, and don't be over reliant on what you observed in the past. The past is one sample draw from an infinite variety of potential sample draws that we might get in the future in terms of combinations of inflation, growth, geopolitical risk, supply-demand dynamics, technological shocks, etc. And the future is probably going to look quite a bit different from the past. And so the best way to prepare for the unknown is to diversify. So I think that would be my core message.
All right. We'll put links to the Resolve website so anybody listening to this can go and check out their investment strategies and how to contact them. Adam, I know you're on Twitter. Any place else you want people to go?
Yeah, I'm on Twitter at GestaltU. That's GESTALTU. And our website is investresolve.com. So check it out.
Great. Thank you, Adam.
Thank you.
Thanks so much, guys. It's a lot of fun.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.